Hi, welcome to the July 2026 edition of Student of the Market. At THG Retirement Solutions, we break down the noise and provide a clear monthly snapshot of the markets so that you can stay informed and focus on what matters most to you. This month, there's a lot to talk about. The second quarter was one of the strongest quarters for U.S. stocks since 1950, but underneath the market has been changing. So the better question is my portfolio built the right way for where I'm at today? We'll start with the big headline. Even though stocks were down slightly in June, the second quarter was still the 13th best quarter for U.S. stocks since 1950. That makes it the best quarter since the big rebound in the second quarter of 2020. Historically, strong quarters have often been followed by continued positive returns over the next year, but of course, there are no guarantees. The bigger point is markets can move fast, and we just saw that. A few months ago, investors were worried about volatility, election year uncertainty, and whether they should stay defensive. Then the markets delivered one of the strongest quarters in decades. That is why we always come back to discipline. Trying to time every move is hard. Having a plan is much more reliable. This is one of the more interesting charts this month. For the last few years, the Mag 7 dominated headlines and drove a large part of market returns. But in 2026, that has changed. The Mag 7 is actually trailing the rest of the S&P 500 year to date, and only one of the top 7 stocks is outperforming the S&P 500. That is a big shift and probably very healthy. Leadership is broadening, and that is very good for diversified investors. Even though the Mag 7 is not leading this year, concentration is still high. The top 10 holdings of the S&P 500 still make up a large portion of the index. Over 1/3 of the S&P 500's weight is in the top 10 holdings. This matters because many investors may think they are diversified just because they own the S&P 500. But the largest companies still make up such a big part of the index. Your portfolio may be more concentrated than you realize. Owning the market does not mean you are diversified as you think. This slide compares the AI boom today with the dot-com bubble of the late 1990s. Technology stocks have had a huge run during the AI cycle, but the gains are still well below what we saw during the dot-com bubble. That is important context. Not every strong cycle is automatically a bubble, but it also does not mean investors should ignore the risks. AI may be a real long-term theme, but great themes can still become overvalued, overhyped, and too concentrated in portfolios. The takeaway is AI can be a real opportunity, but it should still be part of a diversified plan, not the entire plan. This is probably my favorite slide in the deck because it lines up so closely with how our team focuses on retirement portfolios. This chart shows that capturing 85% of the bull market upside and 85% of the bear market downside historically outperforms simply owning just 100% stock. In plain English, you do not have to have all of the upside if you can avoid some of the downside. That matters a lot for people close to retirement. An even bigger reason this matters is when you start taking income from a retirement portfolio. Big losses at the wrong time can have a much bigger impact. For retirement investors, the goal is not to just make money in good markets. It is to stay in the game through difficult markets. As we wrap up July, the message this month is pretty straightforward. The market had a very strong second quarter, but leadership is changing. The Mag 7 are no longer carrying the market the way they did. Concentration is still high, though, and AI still remains a major theme. Diversification is becoming much more important. For investors close to retirement or already retired, the goal is to not chase what worked last quarter. The goal is to have a portfolio that fits your income needs, your risk tolerance, and your long-term plan. At the end of the day, the question is not whether the market will be higher or lower next month. The question is whether your portfolio is still built for where you are today and where you are trying to be going. If you are near retirement, already retired, or just want a second look at your portfolio, we would be glad to help. Thanks for watching, and we'll talk to you next month.